Hello, everybody. Welcome to an episode of the System2 Podcast. Today, I have the pleasure of speaking with Eric Felder, who has had a distinguished career working in finance, ranging from Lehman Brothers and Barclays, all the way to executive positions at places like Citadel, Moelis. Currently, he is the Chief Investment Officer at Colter Lewis, where they help family offices with investing and many other things. Eric, welcome to the podcast.
Thanks so much. It's great to be here. Excited to chat.
So, Eric, in your vast career in investing, when you're looking at the markets today, what do you think is one theme that is most misunderstood?
I think the one thing that most people have been underestimating is the strength of the global economy. If we go back over the course of the last 18 months and look at all of the unexpected, turbulent that has been thrown at the market, everything from the election to tariffs to an unexpected war to, I think, a lot of doom and gloom that was originally put around AI, where it was going to eliminate a ton of jobs and wreak havoc on the economy. We can look where we are right now, and the war isn't done. You look at what the markets are doing, many are hitting record highs across the globe, not just in the US. And inflation is actually somewhat under control. There's some more work to do. But more importantly, growth is solid. And employment, we're going to get the employment report the day after tomorrow. Employment has also been actually solid. So if you think about how strong the economy is, having all of that thrown at it, it's not surprising to me, for example, when you look at yesterday's market reaction, the minute that the market thought that we could end up with the Strait of Hormuz reopened, and you get a tremendous rally across all risk assets. If you dig into some of the data, in particular on the employment side, most people, I think, thought that software development jobs, for example, would be the first to go from AI. If you look at the data, they're actually increasing at a quicker pace than non-software development jobs. So from our seat, the way we view it is a good human with great judgment and great experience and the ability to look forward by itself is a great asset. If you couple that type of a person with AI, we think it's 1 + 1 = 3. And AI is going to end up being a huge productivity boost and a positive for all the markets, not the doom and gloom that some people have written.
Are there particular sectors that you're more excited about? So it's not as doom and gloomy, but what will be some of the more breakout sectors?
Yeah. So the way we think about looking at the world is we take a step back and first say, what environment are we in as a starting point? And then we try to look for themes that are durable. We're not chasing the shiny new toy. We're trying to look at things that have a 5 to 10-year tailwind to them for some reason. And we put a piece out a few months ago, just laying out our 5 areas of focus. And then that directs where we spend our time looking for good managers, looking for idiosyncratic investments, and directing our families. And those 5 are power and energy. When you think about the AI build out, we're going to have north of $1 trillion of CapEx just to start next year. The total is going to be, this year it's about 700 billion, and the rough estimates are 3 to 4 trillion over the next 5 years. Following those dollars and then following what those dollars do, we think has a 5 to 10-year tailwind to it. So electricity growth, for example, for the last 20 years has been flat for 2 decades. We're now going to have at least 2.5%, maybe up to 3.5% electricity growth. And then from there, you can keep going and look at the different companies and the different sectors and how that power is going to be needed. And we think that's decoupled from the economy. Those dollars are going to be spent, and whether the economy is strong or not, that electricity demand is going to be there. The second is healthcare. It's a sector that has had a tough run. When we look at AI and its effect on every piece of healthcare, whether it's on the innovation side, on biotech, or if it's on the efficiency of data, really interesting uh, data question. 30% of all the data in the world is healthcare related, and it's growing at a 30% per year clip. Putting an AI overlay to process and integrate and have systems talking to each other, we think, for example, is a tremendous, again, 5 to 10 year tailwind. The third one, we combined defense, and this is a somewhat unfortunate one, as I think we're all aware, the world isn't particularly getting along right now. We don't see that changing really anytime soon. And we obviously have the SpaceX IPO, which now has everybody focused on space. But if you combine space and defense together, we think again there you have another 5 to 10 year tailwind you're now at a point where a satellite is being put up in orbit almost every single day, which I don't think everyone fully appreciates. And if you think about the use of those satellites, it's not really its own industry. It's like technology in that it goes across every single industry. So I'll just give you one simple example. We're all very used to tapping and paying for anything now, not using a credit card or cash. Every time you tap or pay, that transaction gets time stamped. It gets time stamped by a clock, an atomic clock that's up in on a satellite. So we don't realize it and feel it each day, but space and satellites are touching our day-to-day existence in almost every single underlying industry as well. The fourth spot is commodities, and this ties into everyone not necessarily getting along, but also all of this technology build out. You look, for example, in China, 60% of all cars sold are electric vehicles. There are a lot of underlying components that are used in electric vehicles that those underlying commodities are going to be in demand again for 5 to 10 years, and there's a finite supply of them. You also have the build out of all the data centers, which takes things like simple things like copper and other different elements. And we think you look at the commodity space, and again, similar to healthcare, it's had a very tough run for a period of time, but now we think all of the ingredients are there for persistent demand for the rare earth minerals, everything from that all the way to the industrial metals. And then the last spot is what we call AI picks and shovels. Uh, Mentioned the $1 trillion of capex and the total being well north of that. What we're not comfortable betting on is what the necessarily return on investment is going to be on that capex. We'd rather go downstream to where we know the dollars are going to be put to work. And that's on everything from cooling systems that are needed and other different components or the actual physical building. You just look recently, Caterpillar reported its greatest quarter in the history of the company because all these data centers and all this infrastructure has to get built. So we would rather play that space where we can underwrite outcomes without a very uncertain ROI as the basis for the ultimate investment. So that's the very big picture and the five themes.
When you're thinking about AI, you mentioned CapEx can be a little bit scary because you can't measure the return on that. Curious if you can say more about it. What are some of the pitfalls to potentially avoid when everyone's talking about AI and there's all these positive themes around it? Why are you bullish on the picks and shovels and less so on some of the more core AI companies?
Yeah, well, so I think on the core AI companies, what is happening now when you look at the hyperscalers is those companies have had tremendous earning growth and they are tremendous companies to begin with. There's no question about it. But they are now shifting in a pretty significant way the way they're looking at the markets and what they're doing with their free cash flow. And they're now using the debt markets. So what has now happened is CapEx that was originally organically funded still left a tremendous amount of cash flow with all those companies. And what they did with that is they would invest in future projects, but then also buy back a tremendous amount of stock. And if you look at the course of what's happened this year, all of those companies are now not only not using their free cash flow organically, but they're turning to issuing incremental equity and issuing incremental debt, both on and off balance sheets. So you've had data centers where the data center itself, for example, is raising the debt, and then you're seeing the leases guaranteed and the value of the property at the end of the lease guaranteed, let's say, by a hyperscaler. It's very hard for us to say what is the terminal value in 20 years of a data center in a location that doesn't have an obvious secondary use. On the real estate side, it would be very easy for us to get our head around, for example, a retail real estate investment where the box could be used for a number of different things because it's in a location with high traffic and good growth. So it really comes down to the uncertainty where you can't underwrite it down to a specific outcome. You just have a range of them. And then the shift to debt financed CapEx from just cash flow finance CapEx is essentially turning those companies more into asset heavy companies versus asset light companies. And when you go through that transition, the chances that they maintain their premium valuations and premium growth rates, we just find it harder to put bookends around it, such we would rather, I would call it play it more safely and go down the fairway of where we can come up with the analysis in a way that we could get our head around the underwriting.
You mentioned a couple of themes across these. Well, there's some sub themes across these like 5 themes that you mentioned. And when you're talking about healthcare, the demand for healthcare and what AI and data is doing there, I've been thinking a lot about how it seems like right now we're doing fine. The population is generally healthy. Like, sure, we can be a little bit healthier. But when you actually get down to it, I feel like there's so much pent up demand for healthcare out there. Like if I had continuous monitoring and testing of my body in real time, like the fact that I go to the doctor once a year and get measured is kind of crazy when you can get data in real time now. And there are obviously companies and apps and wearables that are starting to do this. But and then when we combine this with telemedicine or just people sending a picture of their rash to ChatGPT and asking them like, is this a tick bite? Do you feel like there is so much more demand for these services if only the prices and the friction would come down?
I think there is. I also think you have to couple it with broad-based education as well, because I think what the big shift that has to occur, and I think it's going to occur, is preventative medicine versus reactive medicine. Until reasonably recently, as you said, people go and you get your checkup. Most people were not taking advantage of some of the technology that had already existed on things like full body scans, um, and continual monitoring and much broader panels, for example, on blood work. And a lot of the reason for that was the cost was prohibitive to your average person. And then you also had different people that either believed in preventative versus not. I think it's pretty well documented now that if you get an early heads up on almost anything, even some of the worst cancers, your probability of coming out the other side healthy is way higher. And so I think what AI is going to do is it's going to bring the costs down because of efficiencies and productivity, where a lot of those services and products are going to be available to a much broader group. There are companies already right now where at home you can submit your blood work, you get a panel that has 1,000 markers on it, not 8, and your data is saved and stored, and you have an app on your phone, and you can get an early warning indicator on so many different things that are going to be a positive for longevity and quality of life, that I think that AI is going to serve to be the catalyst of making a lot of those great technologies better, more affordable, and more and and basically broadly used across the world.
Yeah, and it's interesting. We came across an investment where there's an ophthalmologist that has a successful company already, and he's launching a second one. And the idea is basically telemedicine. You can take a picture of your eye, and it can help diagnose certain common things, so you don't necessarily need to go into your eye doctor. And one of the questions that keeps coming up in due diligence, like, well, is this going to compete with existing ophthalmologists? And him being one, like, he is very much pro doctor, and his thesis is that there are so many more uses of people would use that app much more than are currently going to an ophthalmologist. And you can say you might have something, your eyes a little bit red, or there's a little sty on it. Many people will not go into the doctor for something like that. But if you had an app on your phone that can quickly take a picture and look at it, it can help diagnose some of these things. And maybe it is something that you should get flagged and go into the doctor. So I feel like that there's so much more usage of this technology if it was easier, and at the same time, it doesn't necessarily have to compete with the service providers out there, which is one of your earlier points about competition from AI with existing labor demand.
Yeah, well, so I think there are two real issues. One, I would put it in the broad bucket of friction. And we see friction in all of our lives in so many different ways. It's the same way when in the olden days, you had to go into a bank with your bank book and talk to a teller to deposit $5 or withdraw $10. People didn't do that every day because there's the friction and the time of going to the bank and waiting in line. And once that you then have a banking app on your phone that you can then use, you then use it a lot more frequently because the friction has been removed. The thing I think you have to couple with the friction, though, is trust. And I think when you're talking about health in particular and money, you need to trust whoever or whatever is on the other side. And I think in particular for health, you want to know that there is a proper doctor who is on the other side, and it not isn't just a machine only. Who who knows? They could make a mistake. Who do you call for a follow-up? What do you do? Who do you ask questions to? And I think over time, the same way that the banking apps, people now trust them. At the beginning, I'm sure maybe your parents, I know, for example, my parents, they were not early adopters of putting an app on their phone because they had natural skepticism, which is, i.e., lack of trust in what was happening with their data, who was using it, could you get hacked? Once you have enough reps and time, the trust ultimately gets developed. And then I think things end up, the friction goes away because the trust has gotten to a level where you're then comfortable using it, and then you keep working through all of the other areas of friction. And I think what AI is going to do, it's just going to accelerate all of it.
And on the topic of friction, you were also talking about space and how many people are thinking about it now, given the SpaceX IPO. I wonder what would the world look like if friction of getting something into space goes to zero? Like, what if I could do something in space? What if it's like that cheaper, and any entrepreneur can be like, oh, I wonder what business I could start if I can send up satellites or send up any sort of like packages into space, where we're now not even thinking about that. It's all like major government use cases or maybe some science. But what if this opens up a massive consumer market to do things in space?
Um, I, Look, I think what could end up happening is beyond what any of us can probably comprehend right at this point. But what I would go back to, and it was a very interesting, I don't remember how long it was ago, but Jeff Bezos gave a speech about Blue Origin that I think you can get on YouTube, and he basically said, uh, I should be thankful to all of the people before me that built the infrastructure to ship packages across the world. And that is the people that built the roads, They invented planes, they invented cars and trains and bridges, and he was humble. All he said was, I just built a company on top of the infrastructure that was built. And then a few amazing companies built the logistics layer, which was UPS and FedEx. And the logistics layer was built. And then I just put Amazon on top of that. So when I think about space, really what's going on right now is the cost per load has gone down so tremendously, and the ability to reuse rockets is now almost making getting to and from space somewhat similar to the ability to get to and from LA or get a package to and from Hong Kong. And I don't think there was anyone who could fully predict what was going to end up happening with the build out of all of that infrastructure. And similarly, I think we're going to be amazed at what brand new companies and brand new areas come out of a frictionless ability to get to and from space. It's about being able to get back and forth in a cost efficient way. And I'm sure when you overlay AI with that, there are going to be discoveries that are made where we can spend way more time in a gravity free environment, for example, or with the ability to harness the power of the sun, which Elon has been speaking about as a power source, for example, up in space, as opposed to the way we utilize power here on Earth. And I'm personally just very excited. I wish I was younger, but hopefully the longevity will keep me around to be able to see a whole bunch of the amazing companies and innovations that occur from space. And I think it's going to be an amazing area to spend time focused and investing in as well.
That's all well and good. But you mentioned a couple of times how we're not getting along as a planet right now. Major conflicts, wars that started, that are still going on. It seems like there's some cyclicality to this, where there's periods of globalization, everyone wants to trade and be friends with each other, and there are periods of isolationism and conflict. And forget about the causes, or we seem to be more in an isolationist era, major like nationalist themes, everyone's rooting for themselves. What do you think happens if we come out of, or when we come out of that? Do you feel like the result of trying to spend more time developing our country's economy, while it might, from a purely economic standpoint, hurt us in the short run, but if there is a reopening, does that help? You mentioned the reopening of the Strait of Hormuz as being a major catalyst in the markets recently. But what happens if that happens on a broader scale and all of a sudden China's our friend again and everyone's super optimistic about doing business internationally?
Yeah. Well, look, I think I think we got our answer in the market's reaction the multiple times. We now haven't had this one time. There have been multiple the strait is open moments, and everyone has been met with a somewhat euphoric market reaction. Uh, Markets are efficient at the end of the day. I think our new Fed chairman has I think, an excellent plan to make the market even uh, more efficient, in that he wants to shrink the balance sheet and have the markets really determine the prices of everything, as opposed to periods of time where we've had a lot of central bank intervention in markets across the globe. And I think once that happens, you look at where prices are, and they price in a geopolitical risk premium right now. There's no debate about it, because that is a fact that we are in a period of deglobalization and heightened geopolitical tensions. And I think, and I agree with you, things are cyclical, and to think that things can never go back to a healthier environment, I think is probably a bad bet to make. But to bet that you need the different degrees of what can happen. And if we did wake up and the world was a more peaceful place and people were getting along and collaborating more, that should be a positive for all of the markets, because you would eliminate that geopolitical risk premium that is embedded in essentially in all asset classes at this